Okay, good morning, everybody. Let's start. It's 10:30 here in Munich or in Paris. I'm Ludovic Siron, and I'm the chief economist of the group. I'm very happy to be here today with two of my distinguished team members, Anna Boata, who heads the research department of Euler Hermes, and Andy Jobst, who heads the macroeconomic and capital markets research department of Allianz SE. The idea is to spend an hour together to give you to brush the ground features of 2022, talk a little bit about how we exit from this crisis. We will give a presentation for about 30 minutes, and then we will answer as many questions as we can from the audience. This is why you can see the Slido QR code. Please scan the QR code. This is not to check whether you're vaccinated or not. This is to actually enable you to ask a question to Anna, Andy, and myself. We will show again the QR code, but if you scan it now, then you have it and you can start asking questions. Don't hesitate to ask questions while the first part of this presentation is happening while we are speaking, and then we will make sure we will answer them in the second part. So we have an hour together, and we have a few slides just to anchor some of the numbers and some of the ideas we want to talk to you about today. So Anna will share the presentation. The idea of our scenario for 2022 is very simple. We titled it "Don't Look Up." You may have seen the Netflix movie with a distinguished cast, including Leonardo DiCaprio as a scientist alerting about a meteorite trying to getting to planet Earth. A lot of people have drawn parallels between this movie and what's happening with climate change for the right reasons. The reason why we used this movie is because we give I like the title of "Don't Look Up" because I think 22 will be about not expecting too much, not looking up when it comes to growth, when it comes to markets. And you've seen the equity market reaction since the beginning of the year. When it comes to inflation also, and we will talk about that in this presentation. And so it also means that as we exit the crisis, we have more risks tilted to the downside than to the upside because of the excesses and the exuberances that have been built throughout the past 2 years. We still think, we're going to be okay. You see the rise or the return of geopolitical risk to the center stage. You see a few reasons to be worried on the very strong responsibilities policymakers have in this new world where they have to unplug help without derailing the recovery. But of course, this has a few prerequisites, or at least a few needs to make sure that we have I would say, a normalization that is happening under good auspices. So if I just go to the executive summary, so the next slide, just to give you some messages. I have I think 5 major messages, and then Anna and Andy will dig deeper into some of them. The first one is 2022 is another very good year when it comes to growth because we have tailwind from past policy support. There's still a very strong policy mix. There is still a lot of private savings on corporate and households' balance sheets. The problem, though, is this recovery is very uneven. You see that the recovery looks like an overheated recovery in the US, a bit more depressed in Asia. We see the big divide between the North and the South. The North certainly enjoying the exorbitant privilege of the vaccine, whereas emerging markets are still in this limbo with a few risks. Of course, the lack of reopening or the risk of stop and go still very strong. To a certain extent, also the double risk of the US tightening financial conditions and China not growing as much as expected. China will be contributing its lowest contribution to global growth since 2015 in 2022. So that tells you that there is indeed this multi-speed recovery. And of course, for a global group like Allianz, it means that we have to continue to monitor this risk of decoupling between major regions of the world, but also how capital flows, trade flows will help stabilize this growing divergence between some areas of the world. The second message is really about prices, inflation. When we look back into 2021, we didn't, I think, uh, assess or we underestimated inflation, not because demand is much stronger. Demand has been strong. I mean, the reopening worked, and we were very convinced about that very early on. We knew somehow that the pandemic and the great intervention would avoid a protracted crisis, but I think we underestimated the disruption on the supply chains, how households started to consume much more goods than services, how we maybe have invested not enough in trade infrastructures and have relied a bit too much on very vulnerable supply chains for the past years, and how this is creating the current situation where corporate margins and households' purchasing power is under some risks as inflation is at record high levels in both the US and Europe, but also in a lot of emerging markets. And maybe some central banks will help soothe the situation, but as we will talk about today, we don't believe it will solve all of these supply-led pressures on especially goods prices. As I said before, maybe if you go to the next slide, Anna, the policy outlook is very important. So one of the things that we need to keep in mind is ministers of finance will try to normalize their expenditure levels without taxing too much, as you may have seen. And so the question is, how this is accepted. How can we replug the private sector as we unplug the public sector? And this goes also for the rest of this presentation. Try to remember that we have been in exceptional times, and so whatever we call normalization doesn't necessarily look like 2019. One word on trade. Anna will certainly present that much better than I do. I talked about supply chain disruption. We see energy and supply chain disruption to stay with us till the end of 2022. And therefore this inflation effect to recede into the second half of this year. And I talked about policy mistakes, for us, and this is, what's happening right now. Central banks have been expecting to react. This week we have the Federal Reserve meeting. Next week we have an ECB meeting. They committed already to exit very accommodative monetary policies. The question is how they do it. It is a very tough balance to strike between keeping monetary and financial conditions not too tight or not too contractionary in a way, but also not being too behind the curve and risking price stability. And so this is really a craft, and of course markets have been testing central bank's narratives for the past months. Since the beginning of the year, we've seen that they may have been testing it a bit too much, and there is this need for central banks to regain the policy narratives. And so as a consequence, and then Andy will give you a few insights about this, we see that in 2022, capital markets will react a bit differently from 2021. We saw already equity markets react. We see very little on the corporate credit side, which is a very important investment asset class for Allianz. And the question for this year is how much volatility can we expect from capital markets as policymakers are trying to juggle their different policy targets at the same time, and necessarily not together at the same moment between regions of the world. And this is certainly something that will create a little more pressure. And as I said, and for me in conclusion, risks are more tilted to the downside. There is one upside scenario that we're working together with our colleagues in AIM, where we're all happy together in a greener, more inclusive world. But as you can see, this is not a high likely scenario as of today. The risks that we see that could derail a bit more this exit of the pandemic is indeed the emergence of a variant that could be of bigger proportion. And Omicron looks to be mild, but Omicron could also create more zero COVID strategies in Asia, and so more disruption to supply chains, more disruptions to inflation. especially if China decides to fight Omicron with zero COVID strategies like they did for the past variants. We also see this risk of policy mistakes, especially from central banks, tightening too early and therefore creating with relative ineffectiveness, because most of the reasons behind inflation are supply driven, and so creating negative monetary and financial conditions for growth. And this idea also of divergence, how much divergence within countries. Inequalities, and especially wealth inequalities, have risen very strongly, but between countries, and you've seen these higher tensions on the political side. How can we swallow in 2022 without having or without creating further pressure on trade wars, on energy wars, or very simply just on supply chains again. So I will stop here and hand over to Anna to give you a few insights on the macroeconomic issues underlying this scenario. Anna.
Thank you, Ludovic, and good morning to all. So if we deep dive a bit more into the global macroeconomic scenario, firstly, of course, Ludovic already mentioned, we still see strong growth in 2022 and even 2023. When we look at the global aggregate, of course, 4.1 is much above still long-term average. And even in 2023, when we have the 3.2 and the slowdown that we expect, we can still compare 2023 with 2017, which we remember was a great year in terms of global recovery when we had stimulus at work in the US, but also from China. Now, of course, this recovery still remains uneven for reasons that were mentioned, like the exit from the sanitary crisis, but also China slowing down and trying to cope with downside risks, which are quite high currently, with further policy easing, be it on liquidity, rates, or monetary policy, but also fiscal policy. But we do see limited effectiveness of those policies in order to boost growth of China. So it's more rather keeping downside risks under control than really seeing a comeback of China, which, of course, as you heard, will make its lowest contribution to global growth in 2022 and 2023 since the last crisis that we have seen in China. And of course, that has an impact on emerging markets that, again, are exposed to the sanitary crisis in an uneven way compared to the North, are also exposed much earlier to very high inflationary pressures, so they have been much more reactive in this cycle in order to cope with that, of course, with limited effectiveness in some parts of the world, especially if we think about Latin America. And of course, this and China itself has an impact, not only in Asia, but also to the rest of the emerging markets, especially when we think about commodity exporters. So overall, in this recovery cycle, we have seen emerging markets being a bit decoupling from the cycle of advanced economies. And actually, even in 2022 and 2023, in the baseline scenario, actually this global growth, which is still strong, is more than half driven by advanced economies. So we do have a new pattern where emerging markets are lagging behind advanced economies, and we do know that they are still exposed to a number of downside risks. Well, in this environment, of course, trade will still also remain, trade growth will remain strong. We still see it above long-term average, but going towards its long-term average in volume terms in 2023. You have our forecast here. We do expect 5.4 and 4% in 2023. It still has to do also with catch-up effects. Of course, it's not only demand, but also all the backlogs of work that we do see currently from 2021, but accumulating also with the Omicron wave. There is still heterogeneity among performance of sectors. You also see some of the laggards that will show much stronger trade performance in 2023 than 2022, because we are in this normalization, very progressive and slow normalization of supply chains. And sectors like the automotive sector, for example, or metals or machinery and equipment are much more exposed than others. But of course, Omicron is here not for recession, but clearly for more disruption. And what we have seen since December is that indeed we do see supply-driven price pressures from this new wave. We do see more disruption when it comes to labor, when it comes to the services sector that is slowing down in a very managed way. And clearly that is here still to stay at the beginning of the year. And clearly, when we look at what supply side disruptions mean to inflation, we can say that it's around at least 1/3. If today 1/3 is supply chain and 1/3 if energy, and we do know that these pressures will remain strong in H1, we can of course understand that price pressures will continue to remain high in H1. Now, there are reasons to believe that we have passed the worst case scenario when it comes to supply chain bottlenecks. And clearly, we will see a continuation in this lower pressures when it comes to transportation bottlenecks, for example. We do know that a lot of them come from infrastructure, but some of them came also from the limited capacity, transportation capacity. And on this side, we do see encouraging signs from the new container ship orders, which should actually transform into new ships towards the end of the year. And that will bring additional capacity. Of course, again, infrastructure logistics are still not fixed. And this is the capacity of transportation is only part of the story. But when we look already at the latest numbers that we have for December, when it comes to volumes, when it comes to prices, you see in the chart on the left that we have passed the peak. Now, of course, we still remain at very high levels, but we are going to progressively normalize going into 2023. So 2022 is still a year of transition. Part of the story, and actually 2/3 of the trade bottlenecks are not only driven by transportation or infrastructure, but also input shortages. And actually, this is again one of the major changes that we have seen and we will see going forward compared to 2021, the level of inventories. We have entered the reopening of the economies in 2021 with very little inventories. And clearly that has requested time. Companies have rushed into building inventories, and they are now still in a phase of a just in case and probably will still remain in the first half of this year, given all the sanitary situation. But most of the sectors already reached pre-crisis levels in terms of inventories. So this rush to inventories, even if it has created bottlenecks and it has been done at a high cost, it is a source of resilience for 2022 and should actually contribute to less acute input shortages. And on the other side, we have domestic production capacities that have been also increasing throughout 2021. As you know, cash balances for corporates have been very high. They still remain very high. And there has been an expansion or a very dynamic investment cycle for CapEx expenditures when it comes to the US and to a lower extent to Europe. And we should still see a dynamic investment cycle going forward. Now, of course, supply is one side, demand is another side. And what we see is that we have been into an absorption or depletion of excess savings into 2021, but this is not complete. And we do see the normalization that has happened in the US, but not as fast in Europe. And you have here on the chart on the right, the savings rate, where we do still see excess savings in Europe or in the UK still 2 percentage points above pre-crisis levels. So we still have some room to maneuver to cope with the fact that higher inflation is actually depressing the real purchasing power of households. Now, of course, there's also a rotation that we can expect in 2022, as Ludovic was mentioning, from very strong growth of durable goods that we have seen in 2021 to more services into 2022. There's also a replacement cycle and a more sustainable consumption behavior from households that point out to the fact that we should have less consumption driven by durable goods, which should also lower the supply side pressures going forward. And finally, before I hand over to Andy to go through more the inflation and the capital markets outlook, I wanted to make a point on where do we stand in terms of pockets of resilience for corporates, because we are living in an environment of very high input inflation. We are living in an environment of margin squeeze and increasing interest rates to come in the US and it already happening in the emerging markets, in the UK, in other advanced economies. But I wanted to make a point also on the fact that we are in a very different environment into this normalization cycle where excess cash is still at very high levels, not only in Europe, as you see on the chart on the left, but also in the US. And that's clearly one of the reasons for which the transmission of monetary policy through higher loan rates could be slower than it has been in past cycles. I now hand over to Andy.
Thank you very much, Anna, and good morning to all. Also from my side, it's a pleasure to be with you. Moving on from the corporate sector balance sheet quite seamlessly to inflation, the evolution of corporate cash buffers will also depend on the capacity of firms to preserve their margins by passing on high input prices onto consumers. So this could perpetuate inflationary pressures if pent-up demand remains strong and supply-demand imbalances persist. While inflation expectations have certainly picked up over the last year, especially in the US, our estimates, shown here on the left side, indicate that the long-term market-implied measures remain close to the price stability target of 2%. Our professional forecasters seem to have become more pessimistic about inflation, yet they seem to have lagged market signals and might have even overreacted in recent surveys, as shown here as the red line here that is going up quite rapidly. So while the inflation uncertainty remains high, we also see that the premium investors are prepared to pay to protect themselves against long-term inflation risks has peaked in Q3 last year, but has declined since then. We show that in the right chart as the diminishing negative difference between the five-year inflation swap and the 10-year inflation swap. So you see that the blue and the green line depicting the US and Europe trend upwards again. Next slide, please. If we now zoom in on the US, a key concern at the moment is clearly the tight labor market and the extent this could trigger an adverse feedback loop between high inflation expectations and higher wages. In December, the average hourly earnings have slightly decelerated to 4.7% year-on-year wage growth to remain strong to the tune of about 4.5 to 5% year-on-year this year. The next slide, please, on Europe. We're also watching the risk of a potential wage price loop in Europe. However, as opposed to US, labor shortages have remained relatively contained, and wage pressures have not been outside the historical norm. In fact, the German wage growth, shown on the left side, is at the record low, thanks to base effects, but the ECB will certainly carefully watch second round effects in the upcoming wage bargaining rounds. We see a similar picture for France on the right side. But so far in the Eurozone overall, real wage growth has lagged productivity gains over the last years. What we can say in summary about the current inflation situation is the following. Current inflation is still mostly driven by non-structural factors and is bound to normalize next year. We expect the underlying inflationary pressures to subside gradually during the first half of this year as supply and demand imbalances abate, energy prices decline, and inflation expectations remain well anchored. However, inflation risks are still tilted to the upside. The upside risk, as Anna mentioned, are persistent supply bottlenecks, labor shortages in specific sectors, still high energy prices, excessive wage growth, and higher selling prices to protect producer margins. The downside risk, so the probability of seeing low inflation, is clearly coming from the fact that some pricing power in manufacturing might be limited, and we might also see a normalization in goods demand and a rotation to services where price pressures tend to be weaker. Next slide. Based on the current inflation expectations, we have updated our monetary policy models to project the appropriate reaction of the US Federal Reserve and the ECB. For both the US and the Eurozone, we expect a very shallow hiking cycle with a terminal rate of 2% and 0% respectively. Considering a price target of 2% means that there will not be much tightening in real terms. For the US, shown here on the left side, the recent surge in long-term yields suggests that markets are now expecting an earlier liftoff than in our scenario, but the end point lies slightly below our estimate of 2%, as you can see here on the chart in 2025. For the Eurozone, shown on the right side, the hiking cycle is protracted and even shallower than the US. Our baseline forecast is close to consensus, but we see a higher endpoint here around 0% starting in 2024. Next slide. What's remarkable at the moment is that the hiking cycle might in fact become even shorter, especially in the US. Our analysis suggests that the recent rise in long-term yields was driven by a higher term premium and not higher inflation expectations. So as financial conditions have become undoubtedly tighter as a result, there's a real possibility that the Fed might hit the pause button after 2 or 3 hikes this year. We also just published a very nice paper by a colleague who's looked into that more closely, and you'll see more information about the current analysis. That's clearly not in our baseline, but it is a significant downside risk to our scenario. Also, the current rise in market volatility and the sell-off in equity markets suggests that the Fed might become more cautious about being too hawkish. So if you look at the cumulative distribution of past rate hikes shown here on the right side, this suggests that the Fed rarely tightened monetary policy when equity markets have come under pressure and have undergone a correction much like the one we are seeing now. Next slide. Finally, a quick word on monetary policy in emerging markets. We are likely to see a continued tightening of the monetary policy stance. We know that the emerging markets have been further along than central banks in advanced economies. But while the rising policy rates in emerging markets will put a break in the recovery and mitigate external vulnerabilities, we see that the effectiveness in taming domestic inflation has been limited. In particular, we see 10 emerging market countries here on the left side that are most at risk from a faster than expected US monetary policy tightening. I won't go into much detail, but you see basically the countries that are placed in the top right quadrant. And those are the ones we are most concerned about. Turkey is a clear example with a self-imposed currency crisis, but there are also others in newcomers such as Romania. Next slide. Now to conclude our summary of the economic outlook, let me also say a few words about capital markets. As Ludovic pointed out at the outset in his remarks, the current market volatility around the Federal Reserve meeting yesterday puts even more emphasis on this. And we certainly have our eyes peeled on developments, not only in sovereign debt markets, but also price dynamics in equities and corporate debt, as well as capital flows. And we do so by examining how our macro forecast what the implications are for our macro forecast for market prices going forward. On the corporate debt side, we expect default rates to stay low and increase mildly within our forecast horizon, especially if extraordinary policy support measures are extended in light of the continued uncertainty about the virus dynamics and associated containment measures. Corporate credit spread behavior, which was remarkably stable during the recent past, suggests that we are entering an expansionary phase of the business cycle. Next slide. Based on our decomposition model shown here on the left, we expect that supply could result in a 35 basis point spread widening for the investment grade segment in Europe, and we will project a similar development for the US. Now, next slide. On equities in advanced economies, we find that the economic consensus does indicate a positive outlook for US equity markets. We see this year more of a transition year with much lower returns, but still positive, with rising downside risks. We see a similar picture in Europe, slightly more positive, given that valuations are not as high as they are in the US at present. Next slide. While we do not see a significant market correction in our baseline, we do find that the combination of excess liquidity, margin debt, and large amounts of options positions hint at the bubbly environment, especially in the US. We have not quite reached record levels of excessive margin borrowing, shown here as the right side, the red line, similar to the in the dot-com crisis period, as well as the global financial crisis, but we are inching towards those levels. That's particularly important because money supply is still high, and market capitalization relative to real growth has been trending upwards. Next. And then lastly, last but not least, emerging markets, some observations here. So far, capital flows have been broadly stable. The inflows to China and India continue to be strong. You see here the capital flows month on month for the most important emerging market countries. However, as usual, there is a substantial risk that capital outflows might pick up if external pressures increase and central banks in advanced economies start tightening. That's all for now. That's what we wanted to share with you as part of the economic outlook. And we're happy to take your questions. Thank you very much for your indulgence.
Thank you very much, Andy. Thank you very much, Anna. And we can stop maybe sharing the slides. Yeah, great, so that we see all of you. Thank you so much for all of you that actually asked questions. There are plenty of them, so I will we will answer them, one by one, and try to keep the answers short so that we can go through the entire list. There is one question though. Someone asked a question, but I just asked for clarification because they don't understand really the question. So first question is of course about the Ukraine situation, the Russia-Ukraine situation. How worried are you about the Ukraine situation? Anna, do you want to start on this?
Yeah, well, we are moderately worried, I could say. We do have, of course, and we do look into the implications of a downside scenario, which means a full-blown escalation, which we have as a being said, with an upside scenario of 10, we still see a 70% probability of being still in limbo for the rest of the year, which means that we will still see a negotiation going further with no concrete results, so that at least in H1, but it could take even longer. Clearly, there could be some additional sanctions from the US and the EU, but moderate, not as in an escalation scenario where it could go through the financing, through the banks, and through the gas imports for Europe. However, that means that indeed we will still see volatility coming out of the situation. It is indeed a bad timing because it does come in an environment where uncertainty is high. And when we think about the gas prices and the upside surprise that we have had already since H2 2021, in a baseline scenario, which is a limbo situation, right, for the remaining of the year with no further escalation, we still have gas prices in H1 at close to 120. Moderately lower in Q2, also because of seasonal effects, so still above 100. So that clearly, when you top up 100 in 2022 or almost on average, that clearly brings much further upside pressures when it comes to inflation, but also to household purchasing power and ultimately to social risk in Western Europe. Now, of course, it's also not only about Western Europe, but also about Russia, Ukraine. where we do still see moderate growth in 2022, 3% on average in both cases. Even in an escalation scenario, recession could be relatively shallow in Russia. Russia has built a lot of buffers over 2021. It has a very strong current account surplus. It has very strong reserves. So it can cope with further downside pressures on the currency, for example, or intensifying capital outflows. So yeah, it's a situation that we monitor on a constant basis.
So central scenario, we don't see sanctions on SWIFT, but we have priced in, I would say, or we have this limbo situation in our central scenario, don't look up, that is unfortunately materializing through this spread between oil and gas prices, or at least this energy supply situation, but also in terms of the volatility on capital markets. A follow-up question to you, Anna, is any particular risk stemming from the Central and Eastern European countries, since we are a bit in this zone? Any country that you are concerned about, any country because of the Ukraine Russia situation, or because of other factors?
Yeah. Well, we have the Russia-Ukraine situation, but also the Turkish crisis that is, as we speak, still in a sort of limbo situation too, right? Because it's a question of time, but we don't see any kind of reversal in policies, be it monetary policy or fiscal policy. And clearly, we are in an environment, and we will continue to be, of hyperinflation. So it's a matter of time, not a matter of if. And in this situation, of course, any kind of crisis in the region or with major emerging markets would have contagion effects to vulnerable other emerging markets. We have seen that between Turkey and the contagion to South Africa back in December. But we do fear also for some of the countries in Eastern Europe and some of them in European Union that could actually suffer because they have built much higher vulnerabilities during the COVID crisis. When it comes to debt levels, QE financing, and clearly how much support they can still have in an environment of very high inflation. And I'm talking here referring to Romania, for example,
I thought you would never say it.
Yeah, unfortunately,
because Anna is Romanian, so we always tease her about the fact that Romania is building some imbalances over the past years, and so now it's a bit time to see how they're gonna get out of these super imbalances, this overheating.
And they are coupled, of course, with building social tensions over the past and inequalities over the past 2 years, and I think this is important because it does show the vulnerability to the cycle itself, but also any kind of liquidity stress that we might have, especially in an environment where financing conditions and monetary conditions are going to be tighter. And we are going to be in an environment where financing will be much more difficult, and then redemptions, we do know, are at a very high level in 2022. So yeah, a special attention, I would say, in the region to Romania, Hungary, and to a lower extent to Poland, for example, because they are in this very strong tightening mode and with negative external pressures.
Thank you, Anna. Thank you. Two related questions to end. The first one is, to what extent do you expect a rise in interest rates for the Eurozone? Very timely question. And the second question, which is, I think, very related, is there any difference in the structure of inflation between the US and the EU? What are the resulting different approaches to monetary policy? Andy.
Thanks very much. On the rate outlook, very timely, because we've got on the heels of the FOMC meeting this week, we've got the ECB Governing Council convening next week. Then a bit of a different situation. The macro backdrop is roughly similar, but as pointed out, the nature of inflationary pressures, although carrying similar supply-demand mismatch flavor, the surge of inflation was not as high in Europe, but the divergence of inflationary pressures across the Eurozone countries has reached an all-time high. So the ECB not only has an issue of calibrating its monetary stance appropriately, but also making sure that countries' divergence in price developments and growth prospects are not getting out of hand. What we expect in terms of rates is a first rate hike in the second half of 23. Markets have recently moved forward the liftoff for the effective policy rates to later this year. We believe that it might be a bit of an overreaction at the moment, much like in the US. But in terms of overall hiking path, I think we're well placed and consistent with fundamentals on reaching zero the year after next. On the issue on the underlying the drivers of inflation in the US, we've seen much pressure from the real estate sector, housing prices, automotive. In Europe, similarly, real estate developments have been pushed up, but it's a smaller share. At the same time, energy prices have come through quite a bit, and we expect in January that the base effects will do their magic with energy prices being more behaved now to shave off quite a bit of headline inflation in the Eurozone. And the other development that is a difference between the US, as I pointed out in the presentation, wage pressure has just been so much stronger in the US, and also remarkably non-skilled labor has been quite remarkable in pushing up wages. Whereas in Europe, we see really that wage price loop not being as acute as in the US. Final point on Eurozone, the issue remains making a tough call whether inflation now is becoming has some structural elements. We think it's still much non-structural, but if the governing council decides that inflation is to stay beyond this year, according to the forecast, isn't, obviously it puts pressure on debt sustainability in some of the peripheral countries. And I think there was one question also about the spillover effects and what it does on spreads in the periphery. That's clearly a trade-off between inflation fighting and making sure that if fragmentation doesn't impede the proper transmission of monetary policy in the Eurozone.
Thank you, Andy. What do you expect from the French and the French elections and the Italian situation? Maybe I can take that one, and you guys say if you. So on the French elections, they're happening very soon. They're happening in April. It will be the first time that a country that has the presidency of the EU goes through elections, which is also, the French have the presidency of the EU, and so it's quite an important pivotal time for the EU. I mean, Andy alluded to it. The Europe is at a crossroads now on monetary and fiscal policy. So this is, I think the French elections are a bit underrated. We expect a continuation of policy. So whether it will be with President Macron or candidate Pécresse from the right wing, it will be a bit like in Germany, where even though the leading party of the coalition went from the CDU to the SPD, there is not a big change, right? The elections, the questions around the elections are mostly on security, migration, identity issue, very little on purchasing power or on fiscal discipline, which is also an issue going forward. Of course, it's, as you know, it's a 2-round presidential election. So there is very, the polls intention to the extreme, especially the extreme right, are quite high, totaling 35%, with 2 candidates one Trump-like candidate and one more classic Marine Le Pen. But there are very little chance of winning. The big question that people have and political pundits talk about now is whether if Macron gets re-elected with a very thin margin, whether he can get a majority in parliament. Because this time around, his members of parliament may not be re-elected. So he would have to anyhow cohabit somehow, certainly with Valérie Pécresse's party, so with the right wing. And so this is the higher risk right now for us is a deadlock in policy making at a time where France has a lot of unplugging to do with the massive fiscal helps and so forth. So we don't expect major stress on the spreads on the OAT, on the French 10-year government bonds, but it's something that is going to be a bit chaotic, and COVID is massively ruling the action. On the Italian side, it's a much more complex situation. As you know, Prime Minister Draghi did a very good job at giving a good positive spin to Italian structural reforms, but also to the Italian super stimulus at 325 billion between next generation EU funds and domestic fiscal stimulus. So there are a lot of stakes in who replaces Mario Draghi should he become president with a non-executive role. The big question, so this week is very pivotal in a way, because should Mario Draghi move to the presidential chair, some parties, especially the Lega, so the right-wing party, ask for a more balanced government, right? Prime Minister, if Mario Draghi becomes president, and can he get as much traction as Mario Draghi got into moving the policy reforms in Italy further? The natural heir is Enrico Letta, the president of the Secretary General of the Partito Democratico, the center-left party. But the extreme parties are in ambush in a way, trying to see how big of a role they can get in this coalition government. And so for me, here again, the policy deadlock is risk is the highest risk for Italy at a time where Italy, Europe was very supportive of Italy accessing a major tranche of the stimulus, but with the balance of reforms and the promise of potential growth that would be much higher than it has been in the past 10 years. And then, to be fair, this story of policy deadlock is also one of the US. If you think about the midterm election in the second part of 2022. So you see, this is why we talk about policy mistakes. If there is really an impasse on France, Italy, or in the US, it could create a less policy support to getting out of this crisis without too much inflation, too many insolvencies, too much recession risk, and so forth. Another question is, how do you expect the Chinese economic slowdown to affect other major emerging markets? Anna, you want to take that?
Yeah, I can take that. Well, it's clearly visible currently that China slowed down, and especially particularly the domestic demand sluggishness is affecting emerging markets overall, but also other countries. And the main, of course, channels of transmissions are through trade and import growth. And we do see currently that private consumption in China is almost 2 percentage points below what it should have been pre-pandemic. And that also goes to domestic demand driven by, for example, infrastructure investment. So we have China as manufacturing investment going well, but we do know that that's also driven by the global cycle. But we do have private consumption, infrastructure investment and real estate in general, which are still struggling. So we have the trade channel, and then we have the FDI channel. And clearly, we have seen a bit of sluggishness also from China investing into the emerging world. And we do know that some of the emerging world has been very dependent over the past years to financing from China. And currently, of course, liquidity risks are quite high in China and could have, of course, a repercussion on China's investments abroad, but also the currency, I would say. And I think we need to watch the currency risk. because we see this divergence in the policy mix between China and the rest of the world. We do expect a depreciation, but a managed one. But we could also be in a scenario where actually banks are not necessarily very willing to lend to the real economy. They take macroprudential rules too seriously, and then we are going into much negative confidence effects, outflows, and then a strong depreciation of the renminbi that counterintuitively can also have an impact on trade flows because of the share of USD trade financing. So I think we need to be aware about the downside risks and the channels of impact, and clearly it will be a pivotal year for China in 2022, not only because they need to manage a lot of downside risk, but we also know the electoral calendar in October 2022, and that will drive also policy going forward. And the risk of a policy mistake is clearly not zero.
Thank you, Anna. Investing in world ETFs right now, good or bad idea? It is not a financial advisor webinar, I'm sorry. If I give you an advice now, I'm liable, right? No, I'm kidding. Most seriously, we are the world's largest active investors. So I cannot really support that you go for ETFs, even though we all should have some ETFs. But thank you for the question. Related to this, which is how do negative interest rates on current accounts influence saving and investment behavior? Any advice for us how to handle this personally? Again, all disclaimer apply, but Andy, do you want to take that question? Negative interest rate, saving and investment behavior.
Yeah, absolutely. I think, you know, the issue with negative rates is that we tend to be arguing from the perspective of, you know, purchasing power in really conjuncturally. But, you know, negative rates at the moment in the Eurozone exist for a reason, right? I think without the ECB having moved so aggressively in negative territory, we would have seen a much, I mean, it's pre-COVID, right? A much more higher economic contraction, and that hurts everyone. Obviously, if you have non-dynamic income, then, you know, you're hurt by negative rates when it comes to your savings. So the question is, to what extent are there opportunities to what we refer to as a portfolio rebalancing, right, into assets that still generate positive yield. So in the current environment, we've seen a tendency of going more into equity markets. For institutional investors, alternative investments have become more interesting, corporate debt, etc. So overall, the negative rates are useful to ensure that that growth remains close to potential, which benefits overall because, you know, with higher growth, higher corporate profitability, higher incomes over the medium and long term. I would not go into more details as to, you know, the specific, you know, investment advice as you've seen in our presentation. You know, we argue more from the perspective of you know, our, you know, key exposures we have on the corporate side. But if you look through some of the recent volatility, you know, equity, but also corporate debt has performed really well. And going forward, we will see, obviously, as monetary policy becomes a bit tighter, a greater availability of safe assets again in the space of, you know, government debt, as well as, you know, the NGU issuing AAA rated paper, which has met excessive demand over the last year and will, you know, in all probability, continue to do so. So that's I would leave it at that.
Thank you, Andy. What maybe another question for you? What would be the impact of higher Eurozone rates on Southern European countries such as Greece?
Into that. In a way, it's a bit binary. We need to carefully look at some of the technical issues. irrespective of what happens with COVID, right? We know that the natural rate, so the equilibrium interest rate we are bound to see in Europe, will remain low. We have limited economic scarring, but hopefully going through and coming out of the COVID crisis now, without that major dislocations, reasonable reallocation of resources. Even at that situation, we will see a significant downward pressure on rates. So there's a natural real economy, real activity, downward pressure on rates, in combination with the fact that we need to watch what happens to supply and demand for government debt. Now, Greece is performing well. Has also seen upgrades recently and are eligible for ECB purchases. So when it comes to continued asset purchase by the ECB, that should provide put a lid on spread widening. But overall, ECB is bound to tighten its stance, so the pace of purchases will decline, as a result of which we expect some of that spread compression to go away. That means it requires that our baseline expectation on respectable growth in Greece continues. So if Greece were not to grow at that current rate, and the ECB were to see its hand forced to high rates, Italy being one example where we see some widening of spreads. At the moment, debt levels we have a debt stabilizing primary balance, so in the baseline conditions, Greece looks okay, but there's significant downside risk if the ECB were to be under pressure to prioritize inflation fighting over mitigating the risk of fragmentation. But the ECB still has lots of arrows in the quiver, and I think it's really a single-digit probability at the moment that we see a blowout in spreads. One last point on Greece, it's also a matter of what's available. Greece is a marginal sovereign when it comes to investor preference. So as more safe assets, right, as more government debt becomes available to investors, then investors will make a marginal decision which sovereign exposure to dump. And obviously, they will gravitate to safer sovereigns if there's more around. So there is a risk that, as we've seen in 2015 and 2014, that Greek debt might fall out of favor, not because they're not growing enough, but because there's more government paper that goes around. So watch that space.
Thank you, Andy. I see time is time is up in 2 minutes, so we have, I think, 4 or 5 questions. I will just do quick answers to some of them. So the risk to Central European countries we got. What is your opinion on Ray Dalio's theory of short and long debt cycle from his book Principles for Dealing with the Changing World Order? Ray Dalio is a formidable storyteller, rich person who has time to write books. But there are people before him that talked about, seriously, about cycles, such as Kondratiev. What I mean by this is, I think he got a point, which is the 20th century has been mostly about debt. Maybe the 19th century was mostly about equity. The 20th century was mostly about debt, because of the wars and because of the financiarization and so forth. And the big question that I have, beyond the fact that maybe there are short and long debt cycles, as he says, but is whether the 21st century will be more about impact, will be more about a savant mix of equity and debt, about hybrid, about blended, but mostly about impact. I hope that we will be much more careful about debt intensity, but also about returns of the debt, quality of the debt. But certainly it's true, we are getting out of a very long debt cycle, which got much amplified by the crisis. Do you believe that energy and gas prices will see a reversal of trend in 22? In that scenario, we'll have a bit more about this. It's very hard right now to look through the energy prices because there are short-term issues, just the geopolitics, demand, and but also the long-term issues. the decarbonization pressures, and so what we expect, I think, is a slightly higher and more volatile regime of energy prices globally. So a bit more than before the crisis. We hope that the current spike or hump is temporary. At least that's the main assumptions behind the receding inflation in the second part of this year. But as you can see, it is becoming a complex topic, especially as governments have to make very strong choices on how they want to handle carbon price as an incentive to decarbonize in a way, and so that will certainly change, I'd say, the price of fossil fuel energies. Do you see any vulnerabilities from current dynamics in relationship between Germany and China? It is a tough time. China, Germany is the head of the G7. Europe has a difficult time to position itself against US interest towards China. China is still the number one trade partner of Germany, and Germany has always been very pragmatic in its relationship with China. I think right now the big question for everybody, including for German exporters, is how depressed is domestic demand in China, because this is, this calls for a bit of caution. And of course, on the other side, we talked about supply chains, but I believe that there's always been a constructive approach between Germany and China, its own way of dealing with China. But the Lieferkettengerecht, for example, on the Uyghurs and on the social side of how much of a leader Germany wants to be on making trade more sustainable, could actually complicate the relationship between Germany and China. Inflation, geopolitics, Ukraine, Taiwan, Hong Kong, and tech disruption to distribution model are the three main risks I can detect to best estimate scenario. Agree? Any other? I would say agree. Any other? This risk of policy mistakes. I think this is also something we have in the central scenario as quite likely. And has Allianz to introduce BCM in our Ukraine entity? It's not up to me to decide. It's up to Petros. But the situation in Ukraine is a complex one, and Ukraine was already, for example, in our country risk rating, Ukraine was already borderline in the rating in terms of a functioning state. So it's true that this additional pressure, military pressure, is something complicated, and will certainly ask for some caution on operation continuity in our Ukraine entity. With this, I would like to thank all of you for attending today. I would like to thank also Anna and Andy for their great presentations, and thanking Heike and Brahim for making the logistics happen. We will try to have that, if not on a quarterly basis, but on a bi-yearly basis, so that we can update you on the scenarios. And of course, you can find everything on our Connect space. You can register to our newsletter, Allianz Research. You can write to us to register. You can find everything also on the internet, on Twitter, LinkedIn. We have a podcast. So if you feel bored and you want to listen to some economics, just stay with us and check some of our reports. We just we have a few cool topics coming up in the coming weeks. And so with that, we wish you a wonderful year 2022. I think we can still do that because we're in January. And wish you a great week, and thank you for connecting. Bye-bye.